Hi investor, welcome to the 5th Uncle Stock tutorial of our series. In this tutorial, we will focus on one of the best features of Uncle Stock, backtesting, how to test the effectiveness of your investment strategy. The first question that rises is, how can we measure the effectiveness of an investment strategy? Using the Uncle Stock backtesting feature, we can test our investment strategy based upon results of relevant prior time periods. In our previous screen tutorial, we searched for stocks using several metrics, and we got a list of the best stocks that matched our criteria. Today, we will continue upon those metrics to find out if a particular investment strategy should be successful in the long term. To measure if those metrics are well chosen, we'll be looking at the historical return of the defined screen. Practically speaking, we are testing whether or not the chosen metrics of our previous tutorial give us decent returns and if they would make a sound investment strategy. To start testing our strategy using the backtesting feature, we first have to select several options. We have to choose how many stocks Uncle Stock has to simulate, how frequent Uncle Stock has to rebalance the portfolio, and the sizes of our position. The first option is quite straightforward. We have to define how many stocks we want in our query for the size of the simulation. We can opt for a size ranging from very small, 8 stocks, to very large, 48 stocks. The bigger the simulation, the more reliable the results can be, but the longer it will take for Uncle Stock to calculate. In our example of today, we are going to simulate 24 stocks, the default option. The second option, the rebalance option, defines how frequent and when Uncle Stock should simulate the acquisition and possible selling of the stocks in the portfolio. The first 4 options rebalance the portfolio yearly. The next 2 will rebalance the portfolio every 6 months, and the last option rebalances the portfolio every quarter. We can also choose the starting time of the simulation. If we were to choose for yearly rebalancing, we can pick the option yearly begin Q1, and Uncle Stock will rebalance our portfolio every year at the beginning of the first quarter. The same can be said for the half-year option. In this case, Uncle Stock would rebalance the portfolio every first and third quarter, or the second and fourth quarter. In the example for today, we are going to rebalance our portfolio once every year at the start of the first quarter. For the final option, we have to define the position size. In this option, we have to define if our virtual portfolio should be maximal positioned or if the excess cash should be invested in bonds. For example, if we were to choose maximal positions and Uncle Stock should only find 20 stocks that matched our criteria, it would increase its virtual investment in the 20 stocks. If we had chosen for the option excess cash in bonds, it wouldn't increase the stake in the bonds, but Uncle Stock would invest the excess cash in short-term bonds. Now, we are ready to press the backtest button. Depending on the chosen conditions, it could take a moment to calculate the results. Let us check the results and returns now. At first glance, we can already see that we would get a backtested result of 16% annually. If you press on the little icon on the right side, we can get details of the simulation result. Currently, we can see how our portfolio in the last years would have looked like if we bought and sold the top stocks using the metrics we defined in our previous tutorial. We can also see the returns of our investments using 2 strategies, the yearly renew and the buy and hold strategy. Using the yearly renew feature, Uncle Stock will perform a simulation buying the best stocks of the screening window at the start of the year and sell every stock at the end of the same year. The following year, Uncle Stock will repeat the pattern and will once again buy the best stocks of the screen. We can also see the result if you bought the 12 best stocks of the list and the standard deviation and average beta of the result. In a tab of the buy and hold strategy, we can see a different simulation. Aside from the yearly yields we saw in the previous screen, we can also see what would happen if we bought the best stocks of the screen of every year and hold them until right now. In the backtesting screen, we can also see the average return of the market to see if the chosen metrics would beat the market. We can observe that the average S&P 500 return was 7% in the measured years. We got a yearly backtested return of 16%. So we can conclude that we outperformed the market in the prior time periods using our metrics. So that will be all for this tutorial on testing your investment strategy using the backtesting feature with the Uncle Stock Screener. Hopefully this tutorial was of good use to you and brought you a step closer to making the best investment decisions possible.